At 28, I thought dividends meant I was getting rich. The mistake wasn't buying dividend stocks. The mistake was using an old person's money strategy while I was still young. It was 11:47 p.m. on a Tuesday. I had already checked my brokerage account 3 times that day. The portfolio had moved, net, about 40 cents. But I didn't care about the stock price. I was waiting for something else. A small notification, a number, the kind that tells you a dividend just landed. A few dollars, sometimes 2, sometimes 4. And I remember sitting there thinking, this is it. This is how you build wealth quietly. No drama, no volatility, just steady income, compounding over time. I had no idea I was optimizing for the wrong thing entirely. What I was actually doing, what a lot of people in their 20s are doing right now, is assigning a retirement job to money that is still in its youth. And that mismatch, that single misalignment between the strategy and the season of life, that's what we're going to unpack today. Let me back up a couple years. The market was going sideways. Meme stocks made a handful of people famous and wiped out everyone else. Crypto surged, crashed, promised everything, collapsed, sometimes inside the same quarter. People got scared, reasonably. When volatility scares you, you go looking for something boring. Income, high-yield savings, CDs, SCHD dripping dividends into your account every 90 days. The financial forums were full of it. Passive income, monthly cash flow, the dream of just stepping off the treadmill, the emotional appeal, completely understandable. The math? Brutal. Let's say you're 28. You have $10,000. You put it into a dividend fund yielding 5%. Sounds responsible, right? 1 year later, you get $500. But after taxes, maybe you keep around $365. Then inflation quietly eats another few $100s of purchasing power. So after 1 full year, your real gain might be about $55. That's less than $5 a month. You didn't build financial freedom. You got a notification. Here's the thing about that notification. Your brain cannot tell the difference between a number going up on a screen and your actual purchasing power growing. That little ping hits the same circuit as finding food. You feel responsible. You feel like you're building something. You're actually playing a very well-designed idle clicking game. Here's the piece most financial content completely skips. Money has an age, capital has a life cycle, and the right move for any given dollar depends entirely on where you are in your financial life. Look at the companies paying the highest, most reliable dividends. Think century-old corporations, toothpaste, cable contracts, electric utilities. Picture the board of directors in some glass tower on Park Avenue, staring at the balance sheet. They run the numbers and reach one conclusion. We have no new business line that can grow 20%. So they send the cash back to shareholders. A high dividend yield is essentially a corporate announcement. We are old and we are done growing. Now look in the mirror. You're in your 20s or early 30s. Your income has real room to move. Your skills aren't close to their ceiling. You are early stage capital and you're applying a late stage corporate strategy to yourself, which caps your upside at the exact moment your upside should have no ceiling. Why do people do this? Because buying dividend stocks feels conservative. It feels responsible, but a lot of times it's covering something else. Real professional competition is uncomfortable. Learning hard new skills is painful. A stable ticker gives you something to point to. I'm investing. It's a convenient reason not to fight for a promotion or go get a skill that would actually move the needle. Same starting point, 2 different bets. The first one is based on my own experience, so I'll describe it as plainly as I can. At 28, I put a significant portion of my savings into a traditional telecom stock yielding close to 7%. The logic seemed sound at the time. High yield, established company, consistent payout history. What actually happened was this. I became very focused on not losing the position. Every week, there was a reason to hold. The dividend was still coming. The fundamentals hadn't changed dramatically. That anchoring effect is real. When you're collecting income from something, your threshold for selling it goes way up. So when the AI investment cycle started accelerating, when Nvidia started moving, when Microsoft made its OpenAI announcement, I was mentally anchored to my telecom position, too cautious, too committed to defending what I had. The telecom stock declined anyway, and I had spent the entire holding period focused on the wrong part of the equation. A former colleague made a different call, also 28, also $75,000, IT operations. He spent $5,000 and 6 months of weekends studying for his AWS Certified Solutions Architect Professional. He didn't open his brokerage app the entire time. He came out the other side with an in-demand skill set right as the market was scrambling for AI infrastructure talent. New job offer, $30,000 raise. Put the numbers next to each other. The comparison is instructive. Option A, $10,000 in a 5% dividend fund, a few $100s of taxable cash flow each year. Option B, $5,000 in a skill. That $30,000 raise after 27% tax is $21,900 in your pocket every single year. You invest that in the S&P 500 at 8% annually. Over 30 years, that one skill upgrade creates a $2,481,032 wealth gap. Not a better year, a different financial class. Permanently. So what should early stage money actually do? Not chase income, build the base. The structure is simple, 3 buckets, and the logic behind each one is what actually matters. Bucket 1, the base. Most of your money goes into broad growth assets. You buy the market and you don't touch it. The goal here is surface area. You want as much money as possible sitting in compounding territory for as long as possible. Every dollar you pull out early to chase yield is a dollar that just fired itself. Bucket 2, the upside. A smaller amount can go into higher risk asymmetric bets, frontier tech, AI infrastructure. But here's the rule. You have to be genuinely okay losing this money, not okay with it in theory, while secretly expecting it to double. Actually, okay. Bucket 3, the shield. Keep cash so you're never forced to sell at the worst possible time. This is not an investment. It's your shield. It's insurance against a stupid decision. Because the single worst thing that can happen to a long-term position is being forced to sell it at the bottom just because your transmission blew, or you got laid off and needed runway. That shield exists so your base never gets touched for the wrong reasons. Set it to auto-contribute, then close the app. Beyond the portfolio structure, there's the question of where your attention goes, which matters more than most financial advice acknowledges. The practical recommendation: automate your contributions, then step away from the daily monitoring. The hours you reclaim from portfolio watching are not wasted hours. They're the hours that go into the things with the highest actual return available to you right now. 80% of your financial energy at this stage should point towards your income, your career trajectory, your skill development, the professional relationships that open doors. Not because the stock market doesn't matter. It does. But because your salary is the engine that funds everything else. And that engine has a lot more room to grow than most people fully pursue. The 20% left over is enough to stay informed, rebalance when needed, and adjust your strategy as your situation changes. As for dividends themselves, the strategy isn't wrong, the timing is. Prioritizing income generation over capital growth makes real sense once your portfolio has reached a scale where even a modest yield produces genuinely meaningful cash flow. At $3 million, a 5% yield is $150,000 per year. That changes things. That is a different conversation entirely. The error is not in the destination. It's in reaching for that income before the base is built, before your early stage capital has had the time and opportunity to become late stage capital. Dividends are what you collect after you've built something substantial. They are not how you build it. Institutional investors use a specific framework when they evaluate companies. Early-stage companies get valued on future potential, total addressable market, growth rate. Mature companies get valued on current earnings and yield. Apply that to yourself. An investor looking at you, your decades of productive years ahead, your ability to learn, your income trajectory, would classify you immediately as a premium early-stage asset. And early-stage assets get managed aggressively for growth. You have incredible value right now. Your adaptability, your time horizon, your human capital. Structure your finances to max those out. Invest in high-growth vehicles. Acquire skills that compound your income. Build the base over the next 30 years. Then execute the income strategy. When you have the millions that make those dividends actually change your life. If this gave you a new lens on your money, hit like. Subscribe if you want more of this. And this week, take a real look at where your early stage capital is actually going. Your time counts too. See you in the next one.